The classic 60 to 40 portfolio is not a safety plan. In this environment, it can become a slow surrender plan. That is the first truth. Most people still think a strong stock market portfolio has to look complicated. More funds, more sectors, more bond ladders, more tinkering, more rebalancing theater, more jargon, more evidence that someone somewhere is doing something sophisticated on your behalf. I have never found complexity impressive by itself. I have found clarity impressive, and when I look at what most people are actually trying to do with their money, the real job is not complicated at all. You want growth without constant guessing. You want protection without paralysis. You want enough diversification that one country, one policy mistake, one inflation wave, or one emotional panic does not decide your whole future. And you want some dry powder so that when the world finally hands you something extraordinary at a discount, you are not standing there empty, handed like everyone else. That is not a 27 fun problem. That is a machine design problem, and I think most people are running the wrong machine. The source you gave me gets to this more directly than most investment videos ever do. Under the simple formula, the real argument is that a stock market portfolio should not be built only for one neat economic script. It should be built to keep working across multiple scripts. The source rejects the standard 60% stocks and 40% bonds approach because fixed income may look safe in nominal terms while quietly losing purchasing power in inflationary environments, especially after tax. It then proposes a four-part structure viewed across all paper investments together, excluding the primary residence, rental real estate, physical precious metals, 529 plans, and HSAs, 50% SP 500 index exposure, 10% international stock exposure, 20% gold, and 20% as an opportunity bucket for conviction plays or liquidity. FE file site FE 68, file 0 FE. That is not just an allocation. It is a four-engine machine. And if you understand the machine, you stop obsessing over headlines and start understanding why most portfolios fail long before the math fails. They fail because they rely too heavily on one engine, one country, one narrative, one rate regime, one definition of safety, one emotional script. That is too fragile for the world we actually live in. So I want to rebuild the whole thing for you the way I think about it. Not as four boxes, as one machine with four engines. Each engine has a different job. The first engine is compounding power. The second is geographic spread. The third is monetary armor. The fourth is strike capacity. And if one of those engines is missing, you may still move in good weather. But the machine gets exposed the minute the road changes. That is the whole game. The first engine is the core growth engine. Half the machine, 50% in the SP 500 through an index fund or an ETF. I like that because it starts from reality instead of vanity. Most people do not need to prove they are stock pickers. They need ownership in productive businesses without making their future dependent on whether they guess the next winner correctly. The source makes this point cleanly. If a company weakens inside the index, it can be removed. If a stronger company rises, it can be added. The index itself keeps refreshing toward the more powerful operators in the market. That is not magic. It is simply a rules-based way of staying attached to the strongest part of American business without constantly performing surgery on your own portfolio. FE file site FE 68 file 0 FE. That is why I call it the compounding engine, because this part of the machine does not ask you to be clever every day. It asks you to stay attached to the productive engine of the economy that matters more than people admit. I have watched millions of people waste years trying to look more intelligent than the index, while the index quietly did the hard thing better than they did. It owned the best businesses in changing proportions, removed the weaker ones, absorbed entire industrial shifts, and let time do the work. Meanwhile, the amateur genius was still trying to prove he could outguess the whole market with 6 hot ideas and a podcast addiction. That is not investing. That is ego management wearing a brokerage account. The beauty of putting 50% of the machine here is that you stop arguing with the obvious. American productive enterprise remains one of the most powerful wealth engines ever built. Not every stock, not every theme, not every fashion cycle, but broad ownership of leading businesses across industries. that is still the cleanest compounding engine most people will ever have access to. And the source is right that this lets you capture long-term growth without constant guessing in a world full of noise. The ability to avoid daily guessing is not a weakness. It is one of the most valuable strengths you can own. Fay file a site, Fay turn 68 file 0 Fay. Now, a lot of people hear that and think, fine, then why not make it 100% SP 500 and call it a day? Because the machine needs more than one engine. That brings us to the second engine, geographic spread. 10% international through a broad index fund or ETF, including both developed and emerging markets. The source says many investors ignore this, and that is true. They assume that owning American companies is enough because America is large, profitable, and globally connected. Fine, but 100% in one country is still concentration. It is still one legal system, one political culture, one policy regime, one currency center of gravity, one valuation environment. That is a lot of eggs in one national basket, even if the basket has served the world very well for a long time. Fay file a site, Fay turn 68, file 0 Fay, this second engine is not there because it will always outperform. That is the wrong question. It is there because different economies move through different cycles, currencies, and pressures at different times. That matters. A portfolio is not just a return machine. It is also a fragility filter. If all of your paper wealth depends on one country staying stronger, better managed, cheaper, and more attractive than the rest forever, then you are not diversified. You are patriotic with your balance sheet. Patriotism is fine in parades. It is not a portfolio principle. That is why I like a modest but real international allocation. Not because I think you need to worship foreign markets, because a machine runs better when the second engine is alive. The source specifically prefers a fund that includes both developed and emerging markets. And that makes sense. Developed markets give you more established economies and institutions. Emerging markets give you faster growing but more volatile environments. Together they create regional, sector, and currency diversification without you needing to play global macro tourist every weekend. Fay file a site, Fay turn 68, file 0 Fay. This is a point worth making brutally clear. The goal here is not to maximize return by prediction. It is to reduce the chance that one national storyline silently becomes your whole financial reality. That is what 10% buys you. It buys humility, it buys broader oxygen. And in portfolio design, humility usually beats bravado over long periods. Now the machine gets more interesting. The third engine is monetary armor, 20% gold. This is the part that makes traditional portfolio managers uncomfortable because it forces them to admit that the word safe has been abused for years. The source rejects the bond. Heavy idea of safety because fixed income can lose purchasing power during inflation. A treasury bond paying 3 to 4% may look stable on paper. But if real inflation runs higher and if taxes still take a cut on the nominal yield when held in taxable accounts, then the supposedly safe sleeve is not preserving power. It is simply declining more politely. Fay file a site, Fay turn 68, file 0 Fay. That is not my definition of safety. My definition of safety is not merely less volatility on a statement. It is a better chance of preserving what your money can actually command in the real world. That is why gold matters in this machine. Not because it is a growth engine, not because it produces cash flow, not because it is magical, because it is monetary armor. The source puts it simply and correctly. You can print dollars. You can print currencies. You cannot print gold. If you hold one gold coin for 5 years, you still have one coin. Yes, it did not go to work in the productive sense. But the number of devalued dollars needed to buy that same coin often rises over time because the currency unit itself is being diluted. That is the essence of what the source is trying to communicate. Gold is not there to outgrow great businesses. It is there to absorb some of the damage when the currency system itself is taking liberties with your purchasing power. Fay file a site, Fay turn 68, file 0 Fay. This is where people get intellectually lazy. They say, gold does not compound. Fine, neither does a fire extinguisher. That is not why you keep it. The job of gold inside this machine is not the job of the SP 500 engine. Confusing the jobs is how people build bad portfolios. They want every asset to do everything. They want growth, income, protection, excitement, inflation defense, and emotional reassurance all in one place. That is childish, good machines assign different jobs to different parts. Gold's job is armor. Armor is valuable precisely because it does not need the same conditions as the growth engine to justify its existence. If currencies weaken, if real yields disappoint, if inflation keeps stealing from paper claims, if the policy response to every crisis remains more money creation and more monetary dilution, then gold is doing its job. And if you believe, as the source clearly does, that the system is structurally tilted toward more money creation over time, then an armor sleeve is not paranoia. It is coherence. Fay file site Fay turn 68 file 0 Fay. Now we come to the fourth engine. This is where most people either destroy themselves or finally become adults. The opportunity engine 20%. The source calls it the opportunity bucket. And that is the right phrase. This is the part of the machine where you can express conviction, hold dry powder, make tactical decisions, and adapt to the environment without turning the entire portfolio into a casino. The examples in the source are wide-ranging on purpose, silver, copper, uranium, oil and energy, tech stocks, REITs, Bitcoin, crypto, cash, fixed income other than treasuries, or some combination. The point is not that you must own every one of these. The point is that the machine must leave room for you to act when you actually have a view. Faithful site Fay turn 68 file 0 Fay. This engine is extremely important because it solves two different problems at once. First, it allows personalization without contaminating the whole machine. Second, it gives you flexibility. Most people fail because they do not know the difference between conviction and recklessness. Conviction says, I see a specific asymmetry or opportunity, and I have space for it. Recklessness says, I feel excited. So now the whole balance sheet must kneel before this feeling. That is how gambling begins. The source is wise to contain speculation and tactical exposure inside this 20%. That containment rule is what makes the whole structure sane. You can be right on silver, uranium, energy, a particular tech cycle, a REIT dislocation, Bitcoin, or simply a coming cash opportunity without making your whole future depend on that call. This is not a small distinction. It is the difference between a machine with a flexible engine and a machine driven by a manic driver. Faithful site Fay turn 68 file 0 Fay I like, calling it strike capacity, because that is what it really is. This engine gives you the ability to move to strike when something is cheap, to hold cash when stupidity is expensive, to buy when panic offers terms, to express a conviction without turning conviction into religion. That is why it belongs in the machine. And it is also why I disagree with people who think a perfect portfolio should leave no room for judgment. A lot of passive religion is really just fear of making decisions. I understand the fear decisions can be costly. But a machine with no tactical capacity at all can become rigid in ways that are also costly. You do not need to trade constantly. You do not need to perform intelligence every day, but you do want some capital reserved for moments when the market hands you something obviously better than usual. The key word is reserved, not unleashed. This is why the four-engine machine works. One engine compounds. One engine diversifies geography and currency exposure. One engine protects against monetary decay. One engine lets you act, growth, spread, armor, strike. That is a coherent machine. Now let us deal with the classic alternative that the source rejects. The mainstream 60-40, 60% stocks, 40% bonds. This structure became canon because it fit a world where bonds could play the role of visible safety while also producing acceptable real returns, and where the old institutional story about diversification felt sufficient. Fine, in certain eras and certain tax and inflation contexts, it made sense. But the source's criticism is the load-bearing one. If the true rate of inflation exceeds the interest you are collecting, then that's safe. 40% is not truly safe. It is preserving nominality while quietly surrendering purchasing power. And if those yields are taxed in taxable accounts, the picture can get even worse. Faithfully cite Turn 68 File 0 Fay. This is the central lie modern portfolios keep telling. They confuse low drama with low risk. Those are not the same thing. A bond sleeve can look calm and still be losing the economic war. An armor sleeve like gold can look strange to mainstream advisors and still be doing a better job in the scenario that matters. An opportunity sleeve can look inefficient to purists and still be what saves you when the world finally offers you a bargain. The source makes another point that matters even more than the allocation itself. Most industry standard portfolios are built around financial assets, not around actual protection against multiple real-world scenarios. That is right. Wall Street tends to build portfolios that fit the system as it exists, not portfolios that question the monetary assumptions under the system. If the system keeps printing, debasing, intervening, socializing losses, and pushing nominal prices upward over long spans, then a portfolio needs to be able to handle growth periods, inflation periods, currency weakness, and opportunity shocks. One outcome is too narrow. Fay file cite Turn 68 File 0 Fay. That is what this four-engine machine is really trying to solve. Not what is the prettiest allocation, but how do I build a machine that keeps functioning if the future refuses to obey one neat script? I think that is the correct design question. Now let me say something about behavior, because the source is absolutely right that behavior is the real battlefield. A good allocation can still fail inside a bad nervous system. People panic during downturns. They sell because they cannot tolerate seeing red. They try to time the market because feeling active is emotionally easier than feeling patient. They withdraw too early, or they never begin because complexity gives them an excuse to stay financially infantile and call it caution. The source says this clearly. Investing itself is not the hardest part. Consistency and discipline are. Fay Turn 68 File 0 Fay. That is why I like a four-engine machine. It is not only simple, it is behaviorally survivable. Simplicity is not just a design choice, it is a psychological advantage. The more complex your portfolio becomes, the more explanations you can invent, the more knobs you can twist. The more chances you get to mistake movement for control. Simplicity strips away theater. It leaves you with a structure you can actually hold through ugly periods, and holding matters because, as the source emphasizes repeatedly, the system is built around inflation, money printing, and periodic intervention. The source's view is blunt. Assets go through crashes and corrections, but in a money-printing world, the long-term system impulse is still upward in nominal terms. Homes do not go back to 1980s nominal prices. Cars do not go back to 1990s nominal prices. The source uses those comparisons to argue that stocks, gold, and other real assets may fall sharply but are not likely to stay cut in half forever in a fiat system that keeps expanding the monetary base when pain gets severe enough. Fay file cite Turn 68 File 0 Fay. Now, whether one agrees with every ounce of that language is less important than understanding the operating principle. If the system repeatedly responds to pain with liquidity, stimulus, and monetary expansion, then your portfolio must be designed for endurance, not constant prediction. That is the real lesson. Endurance beats prediction in most real investor lives. The source is right that many people fail simply because they are glued to their phones, watching their portfolios, wanting to move things around every time a chart makes them nervous. I have seen this disease for decades. The portfolio becomes a slot machine. Red means danger. Green means genius. A little drift becomes a reason to interfere. None of this is adulthood. It is just anxiety with apps. Fay Turn 68 File 0 Fay 4. Engine machine is useful because it gives every mood less room to interfere. You know what the core does, you know what the spread does, you know what the armor does, you know what the strike capacity does. That knowledge makes it easier to stay still when stillness is correct, and stillness is often correct. Now let me push one point further than the source does, because it is the part people most need to hear. This machine only works if the engines keep their jobs. The compounding engine cannot be turned into a trading account because you got bored. The international sleeve cannot be abandoned every time America looks obviously stronger for a season. The gold sleeve cannot be hated just because it is not entertaining during a growth boom. The opportunity sleeve cannot become a dumping ground for every impulsive idea that makes your pulse rise. That is how people ruin a good design. They confuse flexibility with indiscipline. This machine is not supposed to make you creative every morning. It is supposed to make you hard to break. That is a very different goal, and it is the right one, because most fortunes are not built by one magical insight. They are built by staying attached to productive systems, surviving the bad weather, and having enough spare capacity to act intelligently. When the weather finally creates an opening, that is what the four-engine machine is built to do. And once you see that, the whole argument becomes much simpler. The 50% core owns business growth. The 10% international sleeve reduces national dependency. The 20% gold sleeve protects purchasing power when paper promises get sloppy. The 20% opportunity sleeve keeps you flexible, tactical, and alive to mispricing. That is not random, that is not ornamental, that is coherent. So here is the final truth. Most people do not need more investment ideas. They need a machine they can trust enough not to sabotage. A machine simple enough to survive their own emotions. A machine strong enough to grow in one environment without dying in the next. A machine that does not assume one clean future, one clean country, one clean rate regime, or one clean monetary script. That is why I like this design. Not because it is fashionable, because it respects the real world. And the real world is not a neat optimization problem, it is a moving environment. The investor who admits that early usually has a much better chance of getting rich without losing his mind along the way. That is what I want for you. Not a pile of funds, not a complicated story, a four-engine machine that knows what each part is supposed to do and gives you enough growth, enough armor, enough spread, and enough strike capacity that you can stop worshiping prediction and start respecting structure. Because structure, when it is right, can carry you much farther than excitement ever will.